Understanding Bitcoin taxation is crucial for Bitcoin investors to comply with fiscal regulations and avoid potential legal issues. Here are key aspects to consider. 1. Capital gains. In many jurisdictions, including the United States, Bitcoin is treated as property for tax purposes. Therefore, any gains or losses from the sale, exchange, or disposal of Bitcoin are subject to capital gains tax. The tax rate depends on factors such as your income level, holding period, and jurisdictional regulations. 2. Reporting requirements. Taxpayers are typically required to report capital gains and losses from Bitcoin transactions on their tax returns. This may involve filling out specific forms in the U.S. to report gains and losses from the sale of Bitcoin. 3. Cost basis. Calculating the cost basis of your Bitcoin holdings is essential for determining capital gains or losses. The cost basis is typically the purchase price of the Bitcoin, plus any transaction fees or expenses incurred during the acquisition process. Different accounting methods such as FIFO, first in, first out, or specific identification may be used to calculate cost basis. 4. Holding period. The duration for which you hold Bitcoin before selling or disposing of it can affect the tax treatment of capital gains. In many jurisdictions, long-term capital gains, assets held for more than 1 year, are subject to lower tax rates compared to short-term capital gains, assets held for 1 year or less. 5. Mining and staking. Income generated from Bitcoin mining or staking activities is generally considered taxable income and must be reported accordingly. The value of mined or staked Bitcoin at the time of receipt is included in taxable income, and expenses related to mining or staking may be deductible. 6. Forks and airdrops. In the event of a blockchain fork or airdrop, where Bitcoin holders receive new cryptocurrency tokens, the fair market value of the newly acquired tokens at the time of receipt is considered taxable income. Forks and airdrops may result in capital gains or ordinary income, depending on various factors and jurisdictional regulations. 7. Record keeping. Maintaining accurate records of all Bitcoin transactions, including purchases, sales, exchanges, and transfers, is essential for tax reporting purposes. Documentation should include dates, transaction amounts, counterparties, and any relevant supporting documents, such as receipts or invoices. 8. Consultation. Given the complexities of Bitcoin taxation and the evolving regulatory landscape, consulting with a tax professional or accountant experienced in Bitcoin taxation is advisable. A tax advisor can provide guidance on tax planning, compliance, and reporting requirements specific to your individual circumstances and jurisdiction. By understanding your fiscal responsibilities regarding Bitcoin taxation and adhering to relevant regulations, you can ensure compliance with tax laws and mitigate the risk of potential penalties or legal consequences.